Welcome back to the deep dive. Today, we're doing something a little bit different. We're going to zoom in on a very specific moment in time, like right now, this very weekend. It's Saturday, February 7th, 2026. And we're looking at a single network that, to me, seems to be living in two completely different realities at the same time. We're talking about Hedera, ticker HBAR.
It really is a tale of two cities, isn't it? I mean, it's almost schizophrenic if you just look at the raw data versus the online sentiment.
Right.
Because you look at one screen, let's call it the retail trader screen, you see people just pulling their hair out.
Yeah, I saw the memes in the research folder. People are calling it a stable coin because it just refuses to budge.
Exactly. The price chart is hovering around 8, maybe 9 cents. Sure, it's recovering from a little dip, but it's been stuck in this range that feels just frustratingly flat for anyone who's held for a while.
That's one reality, but then you have this other one.
You do. You swivel your chair and you look at the other screen, the one the institutional world is looking at, and you see something completely different.
And what's on that screen?
You see the world's largest financial and industrial systems. And I'm not being hyperbolic here. I mean the actual backbone of the global economy.
Okay.
Quietly wiring this network into their day-to-day operations, you see this disconnect between the price and the utility that, frankly, shouldn't exist in a rational market.
That's the tension. That's exactly what grabbed me when I was going through the stack of research for this. We're sitting here, February 7th, 2026. Market cap is just under $4 billion.
Right.
But then you look at the milestones from just the last 90 days, and they are enormous. I mean, we have an HBAR ETF that is actively trading on the NASDAQ.
Oh, huge, too.
We have the network tracking over 30 billion real-world items, things like clothing, vaccines, you name it. And on top of that, there are partnerships with NVIDIA-powered tech to verify AI data.
It's a disconnect that is just genuinely fascinating, and that's what we really need to unpack today.
So what's the mission for this deep dive?
The mission isn't just to talk about another crypto token or, speculate on the price. It's to really explore why 2026 is being called the audit era for this whole industry.
An audit era. I like that.
And how Hedera is positioning itself not as like a crypto casino asset, but as the boring essential seatbelt for the coming machine economy.
I love that analogy, the seatbelt. It's not the engine, it's not the flashy paint job, it's the thing that keeps everything from flying apart.
Exactly. It's safety. It's trust.
Okay, we're definitely going to get into that because it reframes the whole value proposition. But first, for anyone who might be new to this, or maybe you've just heard the name scrolling on social media, let's set the stage. What is Hedera? Because the very first thing I learned in the prep is that it's technically not a blockchain.
Right. And if you want to be precise, and in this industry, engineering precision really matters, it is a hash graph.
Okay.
It still falls under that big umbrella of distributed ledger technology, or DLT, but it effectively throws out the architecture that Bitcoin and Ethereum use.
So no blocks, is that what you're saying?
Well, no linear chain of blocks where one has to come after the other in this slow single file line. It uses a totally different structure called a directed acyclic graph, or a DAG.
Okay, we're going to geek out on the DAG stuff later because the mechanics are actually really cool, the whole gossip about gossip thing.
It is.
But for now, broadly speaking, it's a public network. It has a token called HBAR, and as of today, it's sitting around 8-9 cents after a bit of a dip.
That's the snapshot. And to understand why that price point is so interesting or so frustrating, depending on who you ask, you have to look at the sheer volume of, let's call it, adult activity happening on the network.
Right. We're not talking about monkey JPEGs here.
No. We have reports from the new Canary HBAR ETF. We've got governance updates from the Hedera Council, which just added a massive global energy player. And we have this completely new regulatory landscape taking shape in the US called Project Crypto.
So, a lot to unpack. Let's dive right into that adults in the room theme then. Segment 1. Institutional validation. I feel like in crypto, for years, people just screamed ETF, constantly.
Up the Holy Grail.
The Holy Grail, they hope for a price pump, but Hedera actually got one late last year.
They did. The Canary HBAR ETF, ticker HBR, launched on the NASDAQ in late 2025. And as of early February 2026, the numbers are actually quite significant.
Tell me about the numbers.
It's holding roughly 522 million HBAR.
Okay, let's pause and contextualize that. 532 million, is that a lot?
It's about 1.1% of the entire circulating supply. The assets under management are valued around $48.6 million.
Okay.
Now, to a retail trader who's looking for a 100x return overnight, that might sound kind of modest. You might say, well, the Bitcoin ETFs hold billions.
Right.
But you have to understand what this vehicle actually represents for an asset like HBAR. It's not just about the immediate numbers.
It's about access, isn't it? It's about the plumbing.
It is entirely about the plumbing of finance. You have to put yourself in the shoes of a traditional asset manager, a pension fund, maybe a family office.
Okay.
These entities have incredibly strict compliance mandates. They cannot, under any circumstances, manage private keys.
No way.
They're not going to download a Hashpack wallet, write a 24-word seed phrase on a piece of paper, and then, hide it in a fireproof safe in the CEO's office.
Right. If the person with the piece of paper gets hit by a bus, the pension fund loses all its assets. That just doesn't fly on Wall Street.
It's a compliance nightmare.
Yeah.
It's completely uninsurable. They need a qualified custodian. They need a regulated entry point. They need insurance.
They need a ticker symbol.
They need a ticker. Exactly. Yeah. The ETF validates the asset as a commodity in the eyes of Wall Street. It gives them a ticker, HBR, that they can trade right alongside Apple or Tesla or gold.
So it's not just about number go up immediately. It's about building the pipes so that the big money can flow in if and when it decides to.
That is a perfect metaphor. It creates institutional liquidity. It's the bridge. Before this, all that institutional money was stranded on the island of traditional finance, looking over the crypto mainland but having no safe way to cross.
And now the bridge is built.
Now the bridge is built.
Yeah.
And once that bridge exists, it validates the whole asset class. It sends a signal that this isn't just some developer science project anymore. It's a real financial instrument.
And speaking of validation, we have to talk about the governance moat. This seems to be Hedera's calling card, but it's also the thing that makes a lot of crypto purists uncomfortable.
It really is. The Hedera Council.
Tell us about it.
This is the structure that sets them apart from almost everyone else. The Hedera Council is a rotating body of up to 39 global organizations. These are the entities that actually run the initial nodes and vote on changes to the software.
And we're not talking about anonymous whales or anything like that.
Not at all. We're talking about Google, IBM, Boeing, Dell. Titans of industry.
And I saw in the notes that Repsol just joined in December 2025. Repsol they're the massive energy giant, right? Fortune 500.
They're huge. And their reason for joining is so fascinating because it really speaks to where this whole industry is going. They are not there to speculate on tokens.
So how are they there?
They joined to use Hedera for decentralized digital identity, or DID.
Okay, what does an oil and energy company need decentralized identity for? That seems like an odd fit.
Supply chain verification. It's all about proving where things came from. Imagine you're Repsol. You have a supply chain that spans 90 countries. You have thousands of contractors. You are trying to prove to, say, European Union regulators that a specific batch of biofuels you produced is actually sustainable.
Right. You need proof. You can't just say it is.
How do you prove it? Do you use an Excel spreadsheet on your own company server? The regulator will just say, well, you could have edited that.
Okay.
Do you trust the supplier's database? No, they have an incentive to lie.
So you need a neutral zone, a place where the data goes and nobody, not you, not the supplier, can touch it or change it after the fact.
Exactly. That is the core value proposition of a public ledger. It provides what they call legal certainty and multi-party trust. And this is the absolute key distinction. Companies like Repsol or Boeing cannot build their critical infrastructure on a network that might just fork tomorrow.
Let's explain that fear. Because in crypto, forking is common. A disagreement happens and suddenly Bitcoin becomes Bitcoin and Bitcoin Cash. Or Ethereum becomes Ethereum and Ethereum Classic.
Precisely. If you are running a global energy grid or the supply chain for the 787 Dreamliner, you cannot risk your underlying operating system splitting in half because of a fight on Discord between a bunch of anonymous developers.
You need stability. You need predictability. You need like a board of directors.
And that is exactly what the council provides. It provides that corporate level stability. And they actually leaned into this in 2025. They split their branding to make this even clearer to the corporate world.
How so?
You now have the Hedera Council, which is led by Tom Sylvester. Their job is purely protocol governance and security. They are the adults making sure the lights stay on.
Okay, the stable foundation.
Then you have the Hedera Foundation, led by Charles Adkins. Their job is all about ecosystem growth, DeFi, handing out grants, marketing, all the growth-oriented stuff.
That makes so much sense. It perfectly mirrors a corporate structure. You have the board of directors ensuring stability and managing risk, and then you have the executive branch driving growth and sales.
It feels familiar. It feels safe. And when you are trying to attract the Fortune 500, boring and safe is the ultimate feature. They don't want move fast and break things. They want move deliberately and secure things.
Okay, so the suits are on board, the governance structure is there, but none of that matters if the tech underneath it all is garbage. So let's pivot to segment 2, the technology. We touched on it. It's not a blockchain. It's a hash graph. And I remember reading about gossip and thinking it sounded more like a high school drama than a consensus mechanism. How does this actually work?
It's a brilliant analogy, actually, because it's based on how information naturally spreads in any social environment. Let's visualize it. Imagine you and I are in a crowded room with 100 other people. I want to tell everyone a piece of information. Let's say the market is open.
Okay.
So I tell you. Then you immediately turn and tell 2 people near you. Then those 2 people each tell 2 more people.
It's an exponential spread. The information goes viral.
Right. That's the gossip part. The information floods the network incredibly fast. In computer science, gossip protocols are actually very common for spreading data around. But Hedera adds this genius extra layer. This is the gossip about gossip part.
What's that layer?
When I tell you the information, I also pass along a tiny little piece of metadata with it.
And what's in that metadata?
It just says who I heard the information from and when I heard it. And when you pass it on, you add your own stamp. I heard it from the expert, who heard it from the host at this specific time.
Oh, interesting. So we aren't just sharing the transaction data, we are sharing the history of how that data traveled through the entire room.
Exactly. We're building a family tree of the communication, a complete map of the conversation. And here is the magic trick. Because every single node in the network eventually receives this exact same map, we can all sit down independently in our own corners and calculate exactly what the group consensus is without ever having to stop and take a vote.
Wait, unpack that for me. We don't actually vote?
We virtual vote. It's a clever trick. Because I know what you know, and I know precisely when you knew it, and I know what everyone else knows and when they knew it, I can run an algorithm that predicts with 100% mathematical accuracy how you would vote if we actually held an election.
So you don't need to ask me, you just calculate it.
I just calculate it. We all do, simultaneously.
That is wild. It's like a hive mind. Because we all share the same perfect history of the conversation, we all arrive at the same conclusion instantly and independently.
And that's what allows for the incredible speed. We're talking 10,000 plus transactions per second just on a single shard, with finality in about 3 to 5 seconds. And that finality is deterministic.
Okay, define that for me. Deterministic versus, what's the alternative? Probabilistic.
Yes. And this is a hugely crucial distinction that banks and financial institutions care about deeply. Bitcoin and Ethereum offer probabilistic finality.
How does that work?
You send a Bitcoin transaction, it gets into a block. You wait 10 minutes, it gets confirmed. Is it settled? Well, mostly. But there's a tiny, tiny statistical chance that a longer chain could appear and overwrite that block, reversing your transaction.
So you wait for more blocks to be sure.
Right. You wait for another block, now it's safer. Then another. After about 6 blocks, so an hour later, the probability of that transaction being reversed is infinitesimally small. But it is never, ever mathematically zero.
It's probably done.
Exactly. And for buying a coffee, who cares? Probably is fine. But if you're settling a $1 billion bond trade, probably isn't good enough.
No. You need to know it's done.
You need to know it's done. And with Hedera's consensus, specifically, it's asynchronous Byzantine fault tolerance, or ABFT. Once that virtual vote calculation happens, it is 100% done. It is mathematically impossible to reverse. Full stop.
I can see why they call that the gold standard of security. You don't want probable settlement when you're moving that kind of money.
And you want fairness. This is another huge differentiator. On a typical blockchain, you have miners or validators who act as, like, the gatekeepers.
They're the leaders who decide what goes into the next block.
Right, and they can see all the transactions waiting to be processed. They're sitting there in the mempool. So if a miner sees a huge buy order coming in, that's going to drive the price of a token up.
They can jump the line.
They can slip their own buy order in right before it, and then slip a sell order in right after it.
The sandwich attack. I've heard of this. It's like being the bouncer at a club and letting all your friends cut the line.
It's exactly that. It's called MEV, or miner extractable value. It's basically institutionalized front running, and it costs regular users billions of dollars a year across the crypto ecosystem.
So how does Hashgraph stop that?
In Hashgraph, there is no leader. There's no single bouncer. Transactions are ordered based on the median timestamp of when they reach the network.
So it's all based on the clock. Whoever got there first gets in first.
It's based on the network's collective clock. If your transaction reached the majority of the nodes before mine did, you are first. Period. No one can bribe a miner to reorder the transaction because there is no single miner to bribe.
So it's fairer, it's faster, and it's more secure. It sounds great on paper, but technology doesn't exist in a vacuum, right? It exists in a regulatory environment, and 2026 is shaping up to be a massive year for that. The outline mentions Project Crypto. What is happening in Washington?
The tectonic plates are finally shifting. I mean, if you look back at 2023, 2024, 2025, what we had was regulation by enforcement. The SEC would just sue people to make a point.
It was chaos.
Total chaos.
Yeah.
And it's stifled a lot of innovation in the U.S. But in early 2026, we got Project Crypto.
This is the joint initiative with the SEC and the CFTC.
Yes, a joint initiative by SEC Chair Paul Atkins and CFTC Chair Michael Selig. That in and of itself is historic. These two agencies usually fight over who has jurisdiction. Now they're actually cooperating to harmonize digital asset oversight.
And they're moving away from just suing everyone.
They're moving away from enforcement and toward creating a clear taxonomy.
Taxonomy is a really boring word, but it's incredibly important. It means defining what these things are.
It's everything. Is it a security? Is it a commodity? Is it a currency? Project Crypto is finally creating those buckets. And this is where Hedera's long-term patient strategy really starts to pay off.
How so?
They're positioning HBAR squarely as a digital commodity, a utility fuel like oil or wheat, and not a security like a stock.
And we are seeing actual legislative wins supporting this, right? The Senate Market Structure Bill just passed committee on January 30th.
Yes, that was huge. And we have the stablecoin bill from Senator Haggerty making progress. This is crucial because Hedera is a leading blockchain candidate for the Wyoming Frontier stable token.
Wait, I think I missed this in the initial set. The Wyoming, what?
The Wyoming Frontier stable token. It's set to be the first ever U.S. state-issued stable token.
A state is issuing its own stablecoin.
That's right. Wyoming has always been the pioneer in U.S. crypto law. They are issuing a stablecoin backed by the state's own treasury. If Hedera is chosen to be the network that powers that, it effectively becomes a piece of government infrastructure.
Wow. Okay, that connects back to something I read about the token release schedule. This has been a really sore spot for a lot of retail investors. Over the last couple of years, the Hedera Council released a massive amount of HBAR supply into the market.
He did.
And the price tanked because of that inflation. But looking at these new regulations, was there a strategic reason they did that?
There was. And this is the big aha moment for a lot of analysts looking back. To meet these new standards, to be classified as a commodity, you need to be sufficiently decentralized.
Meaning no single group can own or control too much of it.
Exactly. If the council or the foundation holds, say, 60% of the token supply, it looks very centralized. It starts to look a lot like a security-like stock in a company.
So by accelerating the token release, wait, you're saying they flooded the market on purpose to dilute their own control?
Precisely. We're at about 86% circulating supply now in early 2026. They flushed those tokens out into the open market.
So they took the short-term price pain to survive the regulatory purge later on. It wasn't just dumping on retail. It was a long-term survival strategy.
It was a decentralization strategy. And now that the supply shock is mostly over because you can't release the same token twice, the fundamental economics of the network start to change. But we'll get to tokenomics in a bit. I want to touch on what this regulatory clarity actually unlocks.
Okay.
Because once the rules of the road are clear, the machines take over.
The machine economy. This is my favorite part of the research. We're not just talking about people sending money to each other anymore. We are talking about AI and real-world assets, RWA.
And Hedera is currently the #1 network for real-world asset development activity. That's not an opinion. That's a fact supported by on-chain data.
Yeah.
Just look at what Archax and Aberdeen are doing.
Okay, Archax is the regulated digital asset exchange, and Aberdeen is the massive traditional asset manager. What are they actually building?
They are tokenizing money market funds and UK gilts, which are basically British government bonds. And this isn't a theoretical pilot program. This is real, live collateral being settled on-chain.
So they're taking traditional financial instruments, turning them into tokens on Hedera, and then what?
And then using them for things like intraday transfers and collateral management.
Let's explain why that matters. Usually, if I sell a bond, I have to wait 2 business days T+2 for the money to actually settle.
Right. And during those 2 days, that capital is dead. It's frozen. It's doing nothing. By tokenizing it on Hedera, you can have instant atomic settlement. You can move millions of dollars of collateral in 3 seconds.
It unlocks a huge amount of liquidity that was previously just stuck in the old banking plumbing.
It makes money move at the speed of email. But the even bigger frontier, and the scarier one, frankly, is AI. You mentioned NVIDIA earlier.
Yeah, Jensen Huang, the CEO of NVIDIA, he's always talking about AI factories.
Yes.
He says we are moving to a world where AI manufactures intelligence just like a factory manufactures cars. But the problem I always see is trust. How do you know the AI isn't lying to you?
Or that the data it was trained on wasn't corrupted. Or that the specific AI model you're paying to use is actually the one doing the work. This is the whole concept of verifiable compute. And this is where Hedera's consensus service, or ACS, comes into play.
Tell me about EQ Lab. I saw that name in the NVIDIA partnership documents.
EQPY Lab is working with NVIDIA's new Blackwell chips and Hedera. Essentially what they do is they anchor the AI's entire data trail to the Hedera network. Every single step of the AI's process, the data it ingested, the processing it did, the output it created, gets a unique digital timestamp and a cryptographic seal on the hash graph.
So it's acting like a digital notary for the AI's every thought.
That's a great way to put it.
Yeah.
Think about deepfakes. Think about an AI hallucinating financial advice or a medical diagnosis. If you have an immutable, unchangeable audit trail on Hedera, you can go back and prove exactly what the AI was thinking and what data it used to come to its conclusion.
So if an autonomous AI agent makes a decision, say, to buy a stock or to reroute a power grid, you can audit the entire thought process because it's all recorded on Hedera.
Correct. It is the seatbelt for AI. If our future economy is going to be run by these autonomous agents, you absolutely need an immutable audit trail. You cannot have black box AI making critical financial decisions.
And they just released a tool to make this easier for developers, right? The Hedera Agent Kit.
Yes, it's a Python SDK. And what it does is it allows AI agents to manage their own wallets.
Wait, give me a real-world example of that, an AI with a wallet.
Okay, imagine an AI travel agent, not just a chatbot, but an autonomous agent that can actually execute tasks. You tell it, book me a trip to Tokyo for next spring.
Okay.
It goes out, it finds the flight, it needs to pay the airline. With the agent kit, that AI has its own Hedera wallet. It can autonomously pay for the flight in HBAR or a stablecoin. It can pay for the weather data API used to recommend the best dates. And then it can get paid by you for its services.
That's robots paying other robots. That is the future right there.
It's the machine economy. And it demands a network that is incredibly fast, incredibly cheap, and has deterministic finality.
Yeah.
You can't have an AI waiting 10 minutes for a Bitcoin block to confirm a payment.
And it's not just the digital stuff. We have the supply chain. I feel like Hedera.io is the sleeping giant of the entire crypto industry. I see this name everywhere in the Hedera transaction stats, but almost nobody on crypto Twitter ever talks about it.
Because it's boring. And boring is where the real money is. Amoeba.io is a platform created by Avery Dennison, the massive packaging and materials giant.
And what are they doing?
They are trapping over 30 billion unique items on Hedera.
30 billion with a B.
Yes, it is by far the highest volume use case in the entire crypto space, bar none.
And what are they tracking? What are these items?
Everything. A carton of milk, a pair of Adidas sneakers, a vial of vaccines. Every single time one of these items moves in the supply chain, it leaves the factory, arrives at the warehouse, hits the store shelf, it triggers a transaction on Hedera.
Why? What's the benefit for them?
Carbon tracking, authenticity verification, real-time inventory management. If you scan a QR code on a shirt in a store, you can see its entire journey from the cotton field to the shelf, and all that data is immutably verified on Hedera.
And then you have Mondelez, the company that owns Oreo and Cadbury. I read a fascinating story about them in the notes. They're not tracking cookies, they're tracking coupons.
They're tracking coupons using a partner called Skax. Apparently, digital coupon fraud is a massive problem for these big consumer brands. We're talking over $100 million a year lost.
How do you even defraud a digital coupon?
People Photoshop them, they copy the barcode and use it 1,000 times online. They exploit the legacy point-of-sale systems at stores. It's a huge mess.
So what's the solution?
By putting the coupon redemption on Hedera, Skax ensures that each coupon has a unique digital identity. Once it's scanned at the checkout, it's essentially burned on the ledger. It cannot be used again.
It solves the double spend problem, but for coupons.
Exactly. It's not flashy DeFi, Deegan, yield farming. It's not sexy. It's just saving a Fortune 500 company $100 million a year.
And that's the audit era right there. It's about boring, reliable, high-volume verification. It's infrastructure.
It is pure infrastructure.
Okay, so we've established the tech is powerful, the regulations are turning favorable, and there are massive enterprise use cases that are live right now. Now we have to address the angry elephant in the room again, the price. We talked about the supply release, but there's another signal in the notes that I think is really important regarding the network's economics. The fee structure actually changed in January 2026.
This was a pivotal moment that I think flew under the radar for a lot of people. For a long, long time, Hedera's fees were kept incredibly low to encourage adoption, a tiny fraction of a penny.
Right, a loss leader.
The loss leader, exactly. But in January, they increased the fee for the consensus submit message transaction. That is the specific transaction type that @BAME.io uses for all those billions of items they're tracking.
By how much? How much did they raise it?
They raised it from 0.00001 to 0.00008.
Wow, that's an 8x increase. That's a big jump.
It is. Now, usually in tech, companies lower prices to attract customers. When you start raising prices significantly, that suggests confidence.
It's called pricing power.
Exactly. It signals that the network is moving from that loss leader growth phase to a phase of economic sustainability. It means they are confident that enterprise users like Avery Dennison see enough value in the service that they're willing to pay higher rates without leaving. It's a sign of maturing product.
And looking at the market sentiment right here in Feb 2026, the trading volume is up significantly. I saw it surge 66% recently.
The signals are very mixed. We have to be honest, when we look at the chart, we just had a death cross on the technicals. That's when the short-term moving average cross is below the long-term one. That's typically a bearish signal for traders.
Right.
But we also just saw a 20% rebound off what looked like capitulation lows. So it's a battleground.
That's a tug of war.
It's a complete tug of war. The market is split right down the middle. You have retail traders who are looking at the chart and seeing a downtrend and years of frustrating price action. Then you have institutions who are looking at the utility, the 30 billion items, the ETF, the regulatory clarity, and they're seeing a massively undervalued piece of infrastructure.
It's the classic transfer of wealth from the impatient to the patient, potentially. But obviously, we can't give any financial advice here.
Never financial advice. But it is a financial observation. The fundamentals of the network and the price action have rarely been this divergent in crypto history. Usually, when network usage goes up 1,000%, the price tends to follow. Here, there's a serious lag.
Okay, so let's look forward. What's on the roadmap? We mentioned something called Project Hyro. What is that?
Project Hyro is the next major step in the network's decentralization. Hedera is in the process of transitioning its core code base to the Linux Foundation Decentralized Trust.
The Linux Foundation, that's the big leagues of open source software.
It is the global standard. Linux runs most of the internet. By moving the code there, it means the code isn't just owned or controlled by Swirlds or the Hedera Council anymore. It becomes truly open source public infrastructure.
And why does that matter so much?
Because governments and huge enterprises require this. They don't want to build on black boxes. They want code they can independently audit, code they could fork themselves if they absolutely had to, and code they know will be maintained and available for decades to come. It removes the reliance on a single company.
So if the Hedera Council just disbanded tomorrow, the code would live on at the Linux Foundation. It effectively immortalizes the protocol.
That's the idea. And on a more technical level, they're also solving the data storage problem. I mean, if you're processing 30 billion items a year, the history of the ledger must be getting enormous. How do the nodes store all that data without getting bogged down?
That's the block nodes initiative that's launching in 2026, right?
Correct. It's a new type of node on the network. Right now, the consensus nodes do everything. They vote on transactions and they also store the history. Block nodes will act as a kind of decentralized data lake. Their only job is to offload that history storage.
So it's specialization of labor.
Exactly. The consensus nodes get to stay incredibly light and fast, focusing purely on speed and security. The block nodes handle the heavy lifting of data storage. This architecture allows the network to scale, in theory, indefinitely without slowing down. And that's coupled with something called HIP 1056, which introduces block streams to make it easier to analyze all that data. They're building the plumbing for a network that can handle global-scale data flows.
It really does feel like they're trying to build a new operating system for the economy.
That's the term that gets used a lot, the trust layer for the internet.
So let's try to wrap this all up. We are here in February 2026. It feels like Hedera has successfully transitioned from being just promising tech to becoming what looks like critical infrastructure.
I think that's the right framing. It has. While other chains are still fighting over who's the fastest or who has the best new meme coins, Hedera has been quietly building this regulatory and governance fortress. They have the council with members like Repsol and Google. They have the ETF on NASDAQ. They have alignment with the emerging Project Crypto framework. Big conservative money feels safe entering this fortress.
It really reminds me of the internet in the late 90s. All the flashy stuff got the attention, the pets.com sock puppet. But the boring, invisible protocols that actually worked, like TCP/IP, are the things that ended up running the entire world.
I think that's a perfect analogy.
Yeah.
The audit era is here. And here's the final provocative thought I want to leave you with. If the future of the economy is really machines, AI agents trading with other machines, do you think they're going to use a slow, expensive bank that's only open 9 to 5?
No, of course not.
And do you think they're going to use a blockchain that might fork and split into 2 different networks after a software update?
No way. They can't afford that risk. The logic would break.
Exactly. They need a trust layer that is fast, final, and absolutely immutable. They need a digital seatbelt.
So the real question isn't when will HBR moon? The real question is Hedera becoming the invisible operating system of the global economy?
And if the answer to that question is yes, then the price chart will eventually have to catch up to that reality.
Look past the chart. Look at who is actually using the network. That feels like the takeaway here. Thank you so much for breaking all this down with me. It's a fascinating time to be watching this space.
It's always a pleasure. The next few years are going to be incredible to watch.
Thanks for listening to The Deep Dive. We'll catch you on the next one.